Welcome to the Getting the Deal Done podcast. My special guest today is my good friend Lisa Forrest with Live Oak Bank. She is making her third appearance, her annual update on what the heck is going on with business acquisition loans. Welcome, Lisa.
Thank you so much for having me, John. Really appreciate it. I almost didn't take your invitation this time because, who knows what's going on, but we can talk about it.
A lot of unknowns out there, but there are some knowns. And given you do SBA acquisition loans, conventional, hybrid, let's start with the SBA. They always come out with some new policies, rules in their memorandum of understanding. What's new with those?
So we're actually waiting for the final version to come out. We have a lot of gossip and a lot of ideas about things that might be coming out. The latest we heard is that the new version might not actually be ratified with all the final comments until maybe even June of this year. And that happens sometimes with SBA. That update process can take a while. A few rumors we've heard that, quite frankly, I'm really in favor of. One of the rumors is around 100% acquisition. As those of you who well know SBA loans, the seller has to exit and you have to buy 100% of the company. One of the rumors we've heard is that there might be able to be some sellers staying on. So especially, John, you know this, you see this, where sellers will give incentive comp to employees that are, maybe more key or general managers or something, but they're certainly not sort of owner operators. So those 5-10% owners might actually be able to stay on. I think that will make for a better transition and just make for a better exit process. So that's one of the rumors, not been confirmed at all.
Okay. I have heard that they are lowering their fees on the first $1 million of loans.
Yes, that is true. And I need to grab that. So on the up to the first $1 million. Now, if your loan amount is above $1 million, then the same fee structure applies. And I prepare people for on $1 million and above, anything above $1 million, kind of 3.5 to 3.25 points on the loan amount, on the SBA loan amount. If your loan is below $1 million, then before your fee would have been $26,250. Your fee is now $7,875. So if you're doing a loan below $1 million, that's really significant. Above $1 million, you still have sort of planning on sort of 3.5 to 3.75%. All transaction costs can be included in the loan amount, though. So regardless of your fee, that can be financed as part of the loan amount, but significant for under $1 million.
Now let's clarify: is that fee on the loan amount or on the guaranteed amount?
It is on the loan amount.
Okay, so you borrow $5 million with an SBA loan. You pay that on the full $5 million, not on the 75% that's guaranteed.
Well, there's a sliding scale on it, by the way.
Okay.
So there is a sliding scale on it, and it is based on the total loan amount based on that guaranteed sliding scale.
Okay.
So, yes.
So more details than we want to get into now.
Yeah.
Okay. So,
but what I do, but why I say the loan amount when I'm prepping people, it's just easier for people to just estimate on the loan amount when they're trying to build out their cost structure. So just put 3.5 points on your loan amount, and then that kind of gets you through all those gradations on the sliding scale for your guaranteed percent.
Okay, great. So big elephant in the room is the higher interest rates, much higher than a year ago when we did this. Talk about what's going on.
So same time last year, January of last year, prime was at 3.25. Interest rates are now higher than that. And I've actually got a little slide here that I'm looking at so that I can kind of walk you through some comments. So over the last 30 years, I think the average interest rate, and this is kind of hard to get your hands on because there's really long periods of time where interest rates don't move at certain points. But I think the average interest rate over the last 30 years, the best I can calculate, is about 6% for a prime rate. And John, you and I know from our days of doing this for 30 plus years, when I was doing the bulk of my lending over my career, I picture prime rate at like 8%. I picture prime rate at 8, sort of your lending cost at 10%. I know that's not the same for our newer sort of entrepreneur acquirers coming into the market, but I think more like 8% as a stabilized interest rate. I don't. How do you think about things over your career?
Well, I think there's what we just experienced has been an abnormality with such a low rate when federal funds were at 0 or whatever. I'll take you back many of those years, and before I was in this business and where I was working, I had a manager, and I remember him making the comment, "Do you think interest rates will ever get below 10% again?" Because you can remember what they were like for a
Yeah,
while.
well,
They were
they
pretty
did.
high.
So right now, prime went from 3.25 back in January of 2020. Prime is now at 7.5. So I ran just a scenario that I think I'll be able to relate in a understandable way. I just ran a scenario at a 7 at prime plus 2 for an SBA loan is pretty average, prime plus 2. So I ran the interest rate at 9.5 on a $750,000 EBITDA company that, say, last year maybe it was selling for $3 million, which that seems reasonable. So same time last year, on an interest rate of kind of more in the 5%, 5% all in, 6% all in, that $3 million purchase price, 750,000 of EBITDA, with sort of a typical SBA structure of 10% down, 10% seller note. I ran the seller note on a 5-year amortization, 5-year term, and we were doing 80% SBA financing. That $3 million transaction was debt service coverage at 1.6 times, 1.6 times DSC. That's cash flow, total cash flow over total debt was covering at 1.6 times. And at Live Oak, our minimum is 1.5. We stand by that debt service coverage. Lots of different SBA lenders will have different debt service coverages. You need to find the fit for you. But that was at 1.6, same time last year on 3 million. So for me now, as I'm looking at, well, could we have afforded that based on our policy? Would we have done that deal again same time now with no changes to that $3 million transaction, no more equity, not lengthening the term of the seller note? That 1.6 is now at a 1.35 debt service coverage today, all things being equal. That is a transaction that we wouldn't be supportive of today at that structure. So we'd be looking for more equity, more seller note, longer term at that same price. So if we're going to keep 10% down, 10% seller note, 5-year amortization, now at today's 9.5% interest rate, what could be afforded at least a 1.5 debt service coverage? And that $3 million purchase price now is $2.5 million purchase price. All things being equal, to at least keep us above minimum our 1.5 debt service coverage. And at 2.5, that's actually at a 1.62 debt service coverage, 9.5% interest rate, all in, 10 down, 10 seller note with that 5-year amortization. So from the seller's perspective, I know it's got to feel very confusing. They're probably coming off their best year ever in some cases, but yet they're going to make less than what they would have a year ago on that purchase price for having had a better year in. So what do you think about that?
Or they need to find a different buyer with more equity.
Or different buyer. Yeah, different buyer. Maybe they go strategic. It is just confusing for the seller right now, because now they're just going to have to come at things a lot differently. Or they take the price reduction too.
Yeah. And for buyers, for the same amount of money, you're going to get a smaller business.
Yeah, for that same 10% down, exactly. Everything held equal to how we were just doing it 9 months ago.
Yep. Yeah.
And I'll put a plug in for the panel that my co-director Heather Anderson and I did last week, where we talked about equity, bringing equity investors in into your SBA transactions. So, having additional equity, inviting other people to participate with you in your acquisition now might be a trend going forward to afford that same level of transaction.
Yeah. So
We'll see.
what do you and what do you think other banks do when someone's a year in and all of a sudden their interest rate has gone up, since most of these are variable rates, and all of a sudden that deal that it was at 1.6 is now at 1.35 or so? What does the bank do in that situation?
Well, with SBA, there are no covenants around debt service coverage. With our conventional loans that we're doing, you have all manner of covenants around senior debt to turn of EBITDA, where if your turn of coverage reduces, then that could actually put you in a covenant default. With SBA, it doesn't work that way. If you are paying us as agreed, we don't necessarily and can't necessarily do anything if your debt service coverage goes down. However, at Live Oak, we have a very collaborative, very communicative relationship with our servicing colleagues. We actually call them business advisors, such that when your kind of financial situation changes, there is a lot of communication between the production side and the servicing side. And I think we have clients, at least that gravitate toward us, that are very communicative as well. So what's interesting is that so far we're seeing a little bit more concerning conversation with some of our CEOs that have closed maybe in the last 3 months to 6 months, not so much our clients that closed a year ago. And I think we're in the middle of knowing and understanding all of this, but I think that as those interest rates sort of gradually increased, our clients from a year and a half ago, were keeping pace with price increases. They were keeping pace with those inflationary concerns out in the marketplace. And actually, quite a few of our clients that closed last year are doing really well, extremely well. But to your point, though, when debt services go down, and we already start with a 1.5 debt service coverage, that's just our philosophy. You should, I think, out there, if you aren't talking to your bank, you really should be, because there's things your bankers can be doing to help you. There's one of our clients that closed more recently that noticed a softening in the sales cycle, a softening in the revenues coming in that were sort of maybe assumed or a little bit more automatic. In the last 3 months, our new operator has really got to be in the field to be generating those sales. They've already had a little bit of a 10% fall off from some long-term customers. So we're actually introducing them to other operators in the same industry that have been doing it for years. So I highly recommend you talk to your bank if you're at all seeing any softening in your debt service coverages.
Thank you. Great advice. You have a 1.5 to 1 debt coverage ratio to do a deal. Tell us about the other things Live Oak Bank doesn't want, because I think that's really a good selling point for you, because you're not going to waste people's time if you're not going to do it at all. So
yeah, and every bank, sort of each lending area is going to have their own specialties. They're going to have things they do really, really well, where they're going to be a great fit for you. And then there's going to be certain credit policies or industries that banks have their own opinions about. So to John's point, you want to make sure you're in the right place with the right bank and the right lender. So at Live Oak, we are looking at the long term, sort of the long haul. We've just gone through 10 plus years of uninterrupted economic expansion. Even during COVID, so many of our clients actually did really, really well. But for us, over the long term, we shy away from things that we know are cyclical in the long run. Ties to new home construction, ties to just new construction, ties to commercial ground up construction. I know our contractor industries out there are coming off of some of the best years they've had. But at the end of the day, That's going to be a cycle. They're leading indicators. They do really well probably before the rest of the economy, and then they start softening in advance of the rest of the economy. So we're just not construction-based lenders. Not that we're not doing service, home service providers like HVAC and plumbing that are more service and maintenance versus HVAC going into new homes. We have a whole vertical around doing HVAC just for homeowners that need service, repair, maintenance. Other things like oil and gas, I mean, we don't know anything about that industry. It's very, very cyclical. I'll add another thing that where you've got a lot of project-based work. You think about that in the construction industry for sure, but there's lots of industries that have a lot of project-based work where clients might have 30% this year, 20% next year, 10 the year, and revenue cycles can go really inconsistently up and down. I think in this lower middle market, that just introduces a little too much risk for what are already highly leveraged transactions. And then we're going to look at the same things you've been preaching about for years, John: seller dependencies, dependencies on suppliers, customer concentration, some of the basics.
And what is on seasonality? How,
Yeah.
is it just a gentle sine wave, or that would that be okay versus the, we do half the revenue in 4 months of the year that we do in the other 8 or something?
Yeah, boy. I think again, for those of you who know me and who know Live Oak Bank, we're going to take a little bit more conservative viewpoint on that one. I would say a little bit of the sine wave is probably okay. They do a little bit more in the spring and fall, or they do a little bit less in the summer, or maybe they do a little bit more around the holidays. That idea of a little bit more or a little bit less versus it's an e-commerce company that does all of their business in November and December, or it's a company that does high winter volume, or no volume at all in winter, and they do everything in summer. We're going to look at those really closely, and I will tell you the deal structure really matters. The cadence of your working capital and having enough working capital is really important, and also what time of the year are you closing? Are you closing right after they've finished their high time and now you're going into low time? Or can you organize it such that you're closing coming into the kind of the seasonal time period? But we're probably going to take a little bit more conservative viewpoint on that one. So with your lender, make sure you've got the working capital figured out.
Okay, well, so let's finish up and talk about any advice you have to buyers and sellers, and basically based on what you've been seeing.
Why? I've always had a really disciplined approach on how I review opportunities with my clients. Sticking to your disciplined buy side methodology, I think, is going to be really important. You've got certain ideas around the types of industries that are going to be interesting to you and why. You hopefully over time are getting to your own point of view, not just what the lender is telling you is good or bad or right or wrong. You as a buyer more than ever have to have your own point of view. What do you think makes sense? You have to have a good feel for going into business acquisition at this time. And we're still going to be busy. We are making loans. So it's not like this is shutting down for us at all. I think that the buy side buyer lender discipline has still got to stay there. We're not increasing our debt service coverage requirements, but we're not decreasing them either. I think we still want to look at deals in the same way we've always looked at them, that I think has served us really well in a practical, reasonable way, understanding the story. And I think for buyers, it's more important now than ever to really understand the role of the seller's role. What was the seller doing? How were they doing it? And the dependencies on the employees. Really understanding that is important. I think on a few of the deals, and this is just directional, I don't have a stat around it, but I think a few of our clients that are going to be just fine, I think they struggled recently with the idea that maybe the seller wasn't as involved and the seller wasn't really involved in the sales generation process. Now the sales are softening a little bit, and our new acquirers are really having to jump in to not only understand the company, which they thought they were going to have a little bit longer lead time to do, but now they're jumping in and they're having to generate those sales because the seller was really involved in that. And as you know, your relationship with your seller is going to vary kind of from deal to deal. So seller advice, just really understanding what the cost of capital looks like right now. And it's not that buyers are wanting to underpay for your company per se. And I understand you're probably coming off of these really big 2022 results, which that feels really good. Now you're coming out into the market. The cost of capital has just gone from 3.25 to 7.5 on prime. And that really is impacting your acquirers' ability to acquire at the price you were thinking. So longer term seller notes, finding acquirers that can come in with more equity, and it's going to just have probably be a really even more so of a balancing act between your price and how the structure of the acquisition sort of needs to work to afford the cost of capital.
Thank you.
Yeah.
So,
what would you say, John? What's your advice?
don't panic. There will always be businesses out there, and it may take little bit or a lot longer to find the right one, but you can't get forced into something. There's a tendency with buyers, if they've been out there a while, is, try to make something more than it is. And you can't do that.
Yeah, I would agree. And I think you articulated that really well. And that's what I meant by staying disciplined. Yeah, don't panic. That's the great way to say it. And ultimately, I think acquirers will find companies.
Right. And for sellers, if you have a good business and you are profitable, you will find a good buyer. It's the ones that are just barely getting by, and use the word potential a lot, that are really going to have a tough time. So, well, thank you, Lisa. Tell everybody how they can get hold of you.
You bet. I am Lisa.Forrest, Forrest, at liveoak.bank. And my cell phone is 425-999-2042. Feel free to text me at any time. And I'll put a plug in for those of you that are just getting started with an acquisition idea. I hold weekly office hours with my lending partner, Heather. Every Wednesday, we go over everything SBA, and we talk a lot about deal structure and process roadmap. So if you email me, I'm happy to share links to join that. And I think my searcher clients find that really helpful. And folks will join often as they go along in their search process. We talk about a lot of stuff with you for an hour every Wednesday.
Okay. And you cover more than SBA in that, as I recall.
Yeah, we have a little compare contrast to conventional. And then we have a compare contrast to a product we have where we can maximize our SBA 7A with our Live Oak Junior conventional in second position to get probably $10-12 million deals done, actually also using SBA.
Okay. Well, thank you so much, Lisa. It's a pleasure to have you on again.
Thank you. Thanks so much, Don. Appreciate it.